Yes, well, the adage goes in markets that if you like something at $143, you should love it down at 91. Of course, there are very good reasons why the Equifax share price has gone down, but in our view, only one of them is material and only one of them ultimately matters. That's whether the business customers end up leaving. Now, the work that we've done shows there's no indication of that occurring. In fact, even some of their business customers have put up their hands and said that they're happy with the way that the company conducts its business and affairs. And even more so, looking back through history at other data breaches that have occurred at credit bureaus and at other financial firms, we can't find any instances of corporate customers leaving that company because of what's gone on there. So in our view, Equifax is a pound coin selling for 50p, hiding in plain sight, and the market's got this wrong. We've bought a lot more of the stock. With that said, we are alive to the possibility that the business customers do end up leaving the company and that the franchise is impaired. One of the reasons Unilever has its strong emerging market footprint is because it had to look overseas earlier on in its corporate life for growth, whereas Procter & Gamble was blessed with a strong, vibrant domestic market. So today, half of Unilever's revenues and profits come from developing countries. For Procter & Gamble, it's only about a third of revenues and less of profits because the margin there is much less mature. So over the long run, we think Unilever is going to have many decades of growth because of its footprint in emerging markets. Anheuser-Busch, we think, is a great business in a great industry. There's strong economies of scale in beer, and it's a well-managed company, not necessarily the consensus view. It suffers, though, in our opinion, because it's a great business wrapped in a slightly weak balance sheet. This is a result of the SAB Miller acquisition from the other year. We're naturally averse to companies with a high level of leverage. People forget how quickly bond markets can and do close suddenly and without warning. And an example of this would be 2009. British American Tobacco struggled to roll over its debts, had to pay its rates as high as 6% for the privilege of doing so. No strong view, if only because it's so hard to be confident about where stock markets are going in the short run. And indeed on this fund, there's no attempts at short-term market timing. We're always run fully invested with very low levels of cash. That said, one of the strong planks to this equity bull market has been the low rates on alternative options for a saver, particularly the interest rates on cash and the yields on government bonds. You can maybe get 3% on the US 30-year Treasury. That doesn't compare very well compared to the 5% free cash flow yield that you can get on equities, and that's a coupon that grows with corporate profits and have some element of pricing power associated with it. But what if interest rates begin to rise more from here? At the moment, on 12-month Treasury bills, you can get 1.4%. But what if you could get 2, 3, 4? There becomes some number at which cash, the yield on cash, improves to such an extent it may take away one of the planks of this bull market. I became a fund manager through a series of steps, really, some small, some bigger than others, but all of them made sense at the time. I think the thing that, looking back, really lit the spark was studying the history of financial markets when I was at university. In my free time, I like to spend my time with my family, particularly going sailing with my boys.